cover. We'll just quickly go over what everybody here is that sort of actually does and why particularly they're interested in today's session. So we'll kick off with Nick.
Sure, yeah. So as I just mentioned, we basically turn well-known self-development books into app-based courses to help people put it into action. We focused on one which is around grief and supporting people through grief, and it's scaling well, and we've got a good team behind us, but we're just realizing that we need to prepare for the exit sooner rather than later, so we're not kind of caught off guard.
Okay, and Nitin?
Hi, I'm from Property Deals Insight. So I founded the business just over 4 years ago now. So we are a PropTech business. We help find and analyze any property in seconds. So we've got like a wealth of data, which helps investors, agents, any other real estate professionals with making savvy decisions. Kind of one of the most powerful platforms in the country. So looking to either scale the business or obviously I saw your invite for this one. So it's always one of those things you have to, as a founder, keep thinking about whether you want to exit now or in the future. So I think that's kind of one of the things I wanted to come in, listen into what you guys had to say.
Okay, I mean, just on our side before we go over to Robert. So I think, well, Nick definitely knows me pretty well. Nitin, so, you know, I head up tech law team at Simons Muirhead, got 120 SME tech clients. And so we basically go from right at the start of their existence when they just need some basic terms and conditions and maybe a bit of IP advice to the exit point when they sell, which is where David, my esteemed colleague here, comes in, super efficient, super good corporate lawyer. And we've done a lot of work, not just for our own clients, but we get lots of things referred to us from people like Seed Legals, who see us as a natural progression from their automated platform for things which are a bit more bespoke and complicated, whilst we can sort of maintain a level of efficiency and a kind of cost structure which is not out of keeping with an automated platform, which is quite an achievement in itself. Now, so Robert, I've met lots of corporate finance advisors over the year, and there's a lot of chaff, and Robert's definitely part of the wheat. I think that's the right way around, isn't it? You want to be part of the wheat, not the chaff, don't you? Anyway, so yeah, worked with Robert now for quite a few years, known him for a long time, and he's terribly knowledgeable and erudite in all areas, particularly focused on corporate finance. So the idea behind today is just to cover some of the areas, as you've seen the agenda. And one of the things Nick said just before was, you know, when does one look to sell the company? We'll come on to that, but first of all, maybe Robert, just give us a few words about Strata and you.
Yes, so firstly, Simon, David, thank you very much for inviting me to participate in this session. So my name is Robert Lees. I'm the managing partner of a firm called Strata Partners. We've been around for about 21 years, providing corporate finance advice primarily in the technology sector, which is quite wide in itself. We do a fair amount of buy-side work, so working with larger companies that are looking to acquire things. That means we understand how the big corporates tend to think. We do probably half of our business is exits for founder owners or venture-backed companies. And then we do some fundraising, sometimes Series A. We try and do more Series B type transactions these days on the fundraising side. Based on Regent Street in London, operating on the buy side pretty globally, and on the sell side and cabaret side across all of Europe. But roughly half of our business has a UK side to it. Not always in England, sometimes in Scotland as well, fortunately. Shall I?
Yeah, just say in terms of areas of activity within technology, it's 100% within technology.
We have one of the original founders is still with us, and he works in laboratory-based services. So that's outside of technology, but the other 10 people in the firm focus on software, some IT services, some fintech, and some e-commerce. So I would say mainly B2B, but not exclusively, and a lot of software or software-enabled things.
And especially as we're sort of not very populous this evening, I think Nick, Nitin, and Aaron, to the extent that you can talk, do feel free to interject, ask whatever questions, shove your hand up, or, you know, even just, I mean, as I say, a few of us, you can just talk, quite frankly. So Nick, you were sort of talking about, you know, your business is going well, and you think sale is somewhere on the horizon potentially. And when does one start to think about these things? I mean, the general answer is people start to think too late. about this and they haven't got things prepared. But I'll hand over to Robert to talk in more depth and with more knowledge about, when to actually start planning for your exit.
Thank you. Okay, so I think
sorry, just before
Yes.
we jump in there, I just wanted to throw in, I guess you have the points in terms of valuation estimations and stuff like that, obviously, especially for SaaS businesses. And again, it depends on when you're looking at selling. From our perspective, we kind of, I would call us like slightly early, and in some ways I'm kind of starting to plan early, but equally I'm also interested in getting the right valuation or maximum valuation, whether it's a case of investment or whether it's a case of an exit or partial exit. I think those are the things which would be quite interesting for me. So then, and as we sort of tailor the session, maybe if we are low on numbers, I think we can try and obviously cover what we like to cover.
Yep, very good. We'll run through the agenda, but I think if we go through a lot of it relatively quickly, it will answer many of the questions, and then we'll hopefully have some time at the end to really drill down on the 2 or 3 topics that are of highest interest to everyone. So in terms of when do you start thinking about selling, I see there's effectively 3 categories. The first is when you have to sell, right? And there are situations where that can be driven by a company running out of money. That's a very typical one. But then you've probably left it too late. The second is if you've got multiple shareholders in the business who no longer get on. That we see quite often also, and life just becomes miserable for everybody, and the easiest solution is to exit. And there can be some other reasons as well that you decide we've got to sell, right? What's important in those situations is that you have the self-realization to see, okay, this is coming up, and you start making decisions quickly rather than letting things fester, right? When something is unsustainable, it will eventually stop and you will end up losing out. So that's one series of situations. In that case, be honest with yourselves, speak to your co-shareholders, what have you, and start moving things forward rather than just hoping things get better. But we'll mainly focus on the other scenario, which is you'd like to sell at some point. How soon before that should you start preparing? So my experience is there's 2 different ways that people think about what they're trying to achieve. One is I'd like to sell to get a certain valuation of my business. Another is I've got a big birthday coming up. I'd like to sell by then, right? So one is a sort of time-driven axis. One is a valuation-driven axis. If you are thinking on a time-driven basis, I would say start doing prep work 2 years in advance of that. There's a couple. It doesn't, that's not to say that it's too late if you start 12 or 18 months in advance, but we have a short presentation we use, and which I'm happy to share in principle, which kind of thinks about a 2-year time horizon. And some of those things we'll come to when we talk about preparing for a sale. But there's a whole host of things that take time to mature, right? And so, for example, options, if you have EMI options and things like that, it's actually a 3-year time horizon. So there's no point in dishing out options to people 3 weeks before you decide you want to sell, because those options won't get the tax advantages. And then you find you have very disgruntled people that you're going to have to pay extra cash to make them whole for what they thought they were getting. But generally speaking, 2 years gives you a good planning horizon to get a lot of things done. If you are thinking about a certain valuation that you'd like to hit, I found a lot of entrepreneurs get a figure in their minds from somewhere, and they assume that their company is the best in the world at what it does, and so it's going to be worth that. And buyers don't see it the same way, right? And so I think getting independent views on valuation and not being offended, but listening to professionals, I think that's quite good. And what I'd say in this sort of small tech world is looking at other transactions that have happened in similar areas and seeing what buyers have actually paid for something gives you a good handle. And we'll come back to valuation in a moment, but don't just think, well, I want to sell one of my companies worth 20 million, and I think it's worth 20 million now. That's probably not, or you might find that you've gone wrong.
And Robert, just a quick question on that. Feel free to push a bit to later. But when you say find out what the value of the transactions are being, I take it that, I mean, that's normally private information. Do you suggest any ways to find that out?
So there are ways of, so it's somewhat private information. It's often it is completely private and you won't find out, but there's a number of transactions where you can find something out. So for example, a good trick is to look at similar businesses that have been acquired by US listed companies, because in their annual reports, their 10Ks, they have to break down what they've spent. Now, if you're looking at Accenture's, which is technically an Irish company, they never disclose anything useful. But if you're looking at a sort of smaller American listed business that's made a couple of meaningful acquisitions, then you'll actually find a wealth of information. And then through good detective work, you could find other valuation multiples. Now, in sectors that we cover very closely, I don't know, travel, distribution, technology, that sort of thing, we scour through footnotes everywhere and so on and find data points that are useful, and we've built up a repertoire of relevant transactions over time. Data center or cloud services acquisitions would be another area. It requires detective work. Corporate finance advisors, they do this for a living, so hopefully they will have some, but it's not easy and you won't have full visibility, but you can find something analogous to your business typically. Might be a bit bigger than you are, but it gives you a starting point, right?
Just
so you
on
mentioned,
that, if I can.
Yes.
That's right.
Sorry, just quickly, you mentioned what it was, the part of the accounts to look into. What did you say they were?
So it's called, in America, an annual report that's filed with the SEC is called a 10-K, 10K, right?
10K, okay.
And the annual ones will have a long list of all the acquisitions that a company has made and may disclose useful information. I see Aaron has got his hand raised, and as he can't speak, go ahead, Aaron.
Yes, I can. Thank you, Robert. Just a quick question on those valuations, because as we spoke yesterday, I haven't really given an introduction to these guys, but we have a products business and a solutions services business. What's the sort of differential in valuation between those two types of company generally?
Okay, wide range of valuations. I would view a solutions business as akin to an IT services business. So I know you do implementation and reselling and so on of solutions. And there, as companies get bigger, you tend to look at EBITDA multiples, right? But the range on revenue multiple terms can be from 0.5 to 1.5 normally. And then if you've got something very special, you can get more than that. And if your margins are very high, you can also get more than that. But for services companies, the range tends to be narrow-ish. And then for software-based companies, it's a combination of, is it very recurring, very sticky, and is it growing fast? And there you get into 3, 4, 5, 10 times revenue multiples, depending on the growth characteristics. We've got a section on valuation coming up in a bit, so let me come back to valuation in a moment. But the range for software businesses is much, much wider than it tends to be for services businesses. Okay.
Okay, before you go on, Robin, I think Nitin had something he wants to ask.
Okay, yes, go ahead.
Yeah, I think it was just off the back of what Robert said. I think looking at the US 10Ks is a good pointer. But I mean, if our business currently operates in the UK, would there be like a multiple or something which we'd look at in terms of comparison? Because valuations tend to be quite different in US versus the UK. So is there like some sort of a ballpark number or fraction or multiple we can think of?
It varies enormously. Let me come back on the valuation points.
Sure,
I see that's a high front of mind kind of topic for everyone, which is fair enough given the title of the session. Maybe the last reason that people think about when to exit is when they've been approached by somebody, right? And if you've got a successful business, almost inevitably, you'll be approached, usually by a subsidiary of a company called Constellation Software. They have a huge team of people who call everything in software, right? B2B, in fairness. But by others, by competitors, by other companies, by private equity, and so on, right? And that often triggers people into thinking about exit. But it's a mistake to be too reactive and start, handing over stuff to the first person who calls. Better to say, we note your interest, we'll think about it, and then get yourselves preparing. Because if you go off half-cocked, you can find it ends up being a complete shambles, right? So you start preparing because you have to sell. You start preparing because you've got a target in mind, or you get approached. I'd say those are the scenarios. And I would say typically, if you have the choice, sit down with advisors and start thinking through things, especially, we'll come to some of the factors. A good 2 years in advance should give you ample time. That doesn't mean that you're spending all your time preparing for exit, but you start getting into the disciplines and start getting things together that you'll need. So I'll pause there for a second. Let me just ask the SMB team or the I don't want to say Simons and Moorhead because I feel sorry for Burton, right? He gets left out.
Burton's the only one who's still with us, I think. So
oh, right, okay.
At least, I mean, well, at least physically, anyway. Yeah, I don't know. David, do you want to pick up on sort of starting the data room process, or do you want to look at that in a bit later? We talk about preparing for the sale process.
I mean, absolutely, I can talk about it now. Yeah, I mean, I'd definitely, build or agree with everything Robert said. I mean, in a funny way, I'm a corporate lawyer, so we come in really, we're most useful for the sprint at the finish. So you're not necessarily going to need us for the whole 2-year period. But I would say, as part of that preparing for sale, sit down with your advisors, including your lawyers, definitely your accountants and your tax advisors, and have a think internally about what are the skeletons in the closet of our business? What have I been sort of worried about? What have I been meaning to tidy up and never got round to? And fix it now, so that when your buyer comes to do due diligence, one, all the problems have been fixed, so it's not going to delay the transaction, creating transaction risk, giving a buyer, a possible excuse to chip the price. And also, so when the buyer does due diligence and gives you virtually a clean bill of health, they get that warm, fuzzy feeling that they're buying a really well-run and together company. Definitely talk to your tax advisor. And as Robert says, 2 years is a really good time to be doing that, because the tax advisor may be able to give you some clever strategies to improve your tax position. And they're not going to be necessarily be able to do that structuring a week before you sell. They need a little bit of time to get it in place. And sometimes that's so that they can justify to HMRC that there were genuine commercial reasons for doing it, and not just because it would save you tax on the exit. So that's a really important one to do early. And then the final one, which is just practical, is, as part of the due diligence process that any buyer is going to do, they're going to want to see a lot of documentation and have a lot of questions for you. Now, some of that is always going to be a little bit reactive depending on their precise requirements, but we can certainly tell you a pretty standard list of the kind of things that they're going to ask you. And to the extent you can get that ready, maybe not 2 years in advance because things are going to change, but 3 months in advance, it means, one, you're not going to sign a heads of terms and an exclusivity agreement and then suddenly have to spend every evening and weekend, pulling together fully signed and dated employment contracts for your entire team. And also it means you can say straight away to the buyer, here's all the information, here's the login details to the virtual data room, knock yourself out, start on the DD process again, so there's no delays. So those are the kind of things we'd say you can do to start preparing for sale.
Yeah, thanks. And that raised a very good point, and we'll come back to tax. The moment somebody has articulated a valuation for your business, it is too late to change things from a tax perspective, right? Because HMRC will use an offer as a reason to say, well, that's the starting price, right? So we've often had people wait too long, somebody's articulated a price, and then they find that they can't move things around from a tax perspective anymore. So doing all of that in advance, getting your options sorted out and so on is really important. Okay, so we've talked a little bit about timing. The second thing is strategy for sale, and there are thousands of variations of these things. typically, when a business is sold, you want to use an auction process to maximize competitive tension amongst buyers, right? Not always, but generally. If you and your advisors have a really good sense of who the best buyers are, you can keep it quite narrow. So people say a rifle shot approach. But you might also say, well, actually, there's all sorts of people all over the world from all sorts of different sectors who'd be interested in us. Let's go wide. And it shapes the process enormously, whether you're speaking to 5 people or 50, right? Sometimes you can say, look, there's one logical buyer. We know them well. They're a good partner. We can say to them, look, give us a fair price. Otherwise, we're going to run an auction process, and you might get a better price out of a bilateral process. It's rare. Usually, you're better off using competitive tension to maximize price. Then there's another dimension. Is your business relevant to strategic buyers, or could it be attractive to private equity and growth equity players? And when I was a baby banker, I remember learning that strategics always pay more because they have synergies, right? And that's what lots of people assume at the back of their minds. In fact, private equity and growth equity can pay more sometimes because their cost of funding is lower, or because they've got a buy and build strategy and they need a platform or what have you. So another thing to decide as you're thinking about what way do I go is strategic buyers, so industry players, or also financial investors. And if you don't know financial investors, it's worth, in that 2-year period, getting to know a couple and just finding out, is it something that is attractive to you, or is it horrifying, right? Some of them can actually be nice.
Richard, Robert, where is the dividing line between private equity and growth equity? I'm displaying my ignorance for all to see there.
It's a continuum that goes from venture capital through growth equity to private equity. And typically, private equity are majority buyers, many of whom are comfortable using debt in a deal. Growth equity will take a large minority or small majority stake, and typically without debt, right? And venture capital is, mainly primary, so new investment and no debt at all. So it's a continuum, but growth equity are like supercharged VCs to an extent, and they're happy to buy existing shares, while venture capital will typically only put in new capital into business and not buy existing shares. Okay.
Thank you.
Good. And then there's a whole lot of other variants that you can think about the strategy for sale. One of them is, am I looking for cash up front, and how important is that for me? And a lot of people do look for that. They don't like the idea of earnouts. They don't like the idea of taking paper. And there's good reasons why you'd be suspicious of all of those things. But those routes can also lead to very successful outcomes if you've got the right buyer and you're taking paper in that company, and you continue to ride the growth with them for a couple of years, especially if you stay involved in that business in some way. That can be very attractive also. And what you often find is, if there's a big difference in your expectation of value and what a buyer is willing to pay, an earnout can bridge that gap, right? So people often go into these processes with very firm views, and then over the course of the process, they learn that actually there's different ways to play this. Okay. What determines the right sales approach is really the seller's understanding of your preferences and your constraints. And so having discussions with people who do this for a living, could be lawyers, could be your tax advisors, maybe could be corporate finance advisors, and just finding out what is possible and what the pluses and minuses are will help you have a view as to what's best for you, right? If you don't do that thinking, you'll have an instinctive approach, and that might not be the best one. The other thing is, you should also be aware that in your company, you will have articles of association, you might have a shareholders agreement that will also constrain what is possible, right? Those things can be amended in good time, but you kind of need to understand them. And most people have them created at the beginning and then don't look at them again, and then they find that they've got funny classes of shares or minority shareholders or something who can block something. So again, there's a bit of housekeeping to be done on that front. The next topic on the shall I pause here for a second just in case anybody has burning questions? Otherwise, I'll go to the choosing advisors item on the agenda.
I'll just say something to kick this item off. One of the things that I only sort of came to my real attention recently was the idea that when somebody has a natural buyer, somebody is approached, and you think, well, I've got the buyer. What's the point of spending money? Obviously, you still need the lawyers, luckily from our point of view, but why would I have a corporate finance advisor in this scenario? And it actually, I'm sure Robert will reinforce this, but you might think Robert's got a conflict of interest there, or self in, is often the negotiation and the price you achieve when you engage a corporate finance advisor is vastly better than if you didn't have one. So the fact that the corporate finance advisor is not necessarily going to find you the buyer in certain circumstances doesn't mean you shouldn't consider having a corporate finance advisor. Over to you, Robert.
Thank you very much. Good introduction. So what advisors do you need? You definitely need lawyers, and I'll come back to SMB on their perspective of what to look for lawyers. You definitely need lawyers. You often need accountants and tax people, right? You need them kind of more to prepare and look for potential issues on the tax side, and then in the process, in due diligence, unless you're a very unusual person, the buyer will have to end up speaking to your tax advisors because you won't know the ins and outs of everything. Big headaches are when you've got operations outside of the UK and when you've got people who are working from outside of the UK but not employed by a separate legal entity. You get into all kinds of complications there, and tax becomes a huge determinant of how quickly you can get a deal done. So regrettably, from my perspective, you very often need tax advisors. Corporate finance is a particular breed of person. They have chosen to specialize in doing M&A transactions effectively. So professionals who spend decades learning tricks, understanding strategies, and so on. In our business, we can often save our clients more than our fees just through smart negotiation of working capital adjustments and debt adjustments and things like that, let alone helping get the headline price up, right? So somewhat biased, but also sincerely believed, is we will help entrepreneurs who don't do this as a living get a much better outcome faster than if they don't have corporate finance advisors. One other important factor is when you are negotiating for your own benefit as the owner of a business, you are directly interacting with the party that is looking to buy you and for whom you might eventually become an employee, right? And your ability, first of all, to argue effectively will be constrained by that. But secondly, there's an enormous help to have a firewall between the discussions that you're having and having the chance to go and think, right? So if you are yourself leading the conversations, you kind of have to make it up straight off the bat and put forward your position or what have you, and you can't easily take a step back and say, okay, let me think about this. Whereas if you've got an advisor, they can do that negotiation on your behalf. They will then eventually say to the counterparty, give me a break. I've got to go and consult with my client. I don't think they're going to like it. And then go off and speak to you and figure out what is the agreed position to come back. They get the chance to think, you get the chance to think, and you come back with a more considered and better view than if you've just responded off the cuff. So lots and lots of other things. I won't bore you with all of them, but that's a surprisingly overlooked part of the answer. There's a few other people that you come across, vendor due diligence or transaction support people who write huge books at vast expense. Very helpful if you're selling to private equity, not at all helpful or hardly helpful if you're actually trying to do a strategic exit. So you'll come across them at some point. Another thing which we often found with entrepreneurs is they've got a 1 day a week CFO and nobody really responsible for HR. and the volume of questions you get on finance and HR is really quite big. So again, I would prepare either by hiring somebody if there's time to do so, or at least having some extra part-time resource to help you with those topics. And an HR person is no use at all if they're hired 6 weeks before the process kicks off, right? They need to know where everything is and who these people are. So there's a couple of other sort of overhead topics that are worth addressing up front. David, you had some good thoughts of what to look for in a lawyer, but also it applies to corporate finance advisors. So let me turn back over to you for a moment.
Yeah, I mean, I think, you know, when it comes to looking for a lawyer, I mean, obviously Simon and I would like to say he found the only lawyers you'll ever need, but no, I think it's important to, you know, talk to, you know, more than one lawyer. Really golden rule, there's no substitute for experience. Talk to the lawyers, ask them what kind of deals they've done recently, you know, people in similar space, similar size of transactions. It's very much, you know, horses for courses. You know, if you're selling a multinational for $100 billion, we're probably not the right firm for you. Similarly, you know, if you're, you know, selling a factory that makes widgets with a turnover of £500,000 a year, you know, some, you know, in Wigan, we're probably not the right firm for you. But if you're selling, you know, an SME tech business for somewhere between 5 and you know, £75 million, that's our space. That's what we're doing all day, every day. We know the kind of issues that are going to come up. We know what's market. And that can help us to kind of help make the transaction smooth, because we know which points we really need to fight for and which we're just never going to win. And we can advise you that, yeah, you know, we've probably got to live with that as part of doing the deal. I mean, lawyers are super regulated, so, you know, you'd hope that you're never going to get a lawyer that doesn't have any technical ability. But again, experience helps kind of build the idea that there's that kind of credibility. And then I think it's, you know, it's about service, you know, making sure people are going to be responsive. You know, we can't ever promise you an M&A deal is going to be fun and easy and isn't going to involve some stress and some late nights, because realistically, they are complicated, difficult transactions. They normally run late. There are normally some tricky, contentious points to negotiate. What we can say is we won't be one of the pressure points. We won't be one of the bottlenecks. And you won't be, you know, having to justify to your buyer why things are running late because your lawyers haven't done their job. And I think that's really important. You know, one way to check that is experience, you know, and you'll also say to people, you know, oh, can I talk to some of the people that, you know, you've done deals with? You know, better still, use a firm that you've got a relationship with, and so you kind of know how they work. And then I think, you know, there's an element of kind of personality, you know, in there for a period of time, for a couple of months while the deal is on. You can easily be talking to your lawyer, you know, more than most other people in your life. And it's important to have someone, you know, whose style you like and who can, you know, adjust how they work to your style. So, you know, for some people that's very email heavy. You know, for some people they want to do, you know, discuss things on a call or in meetings. I mean, we try and adjust our style to the client, but, you know, my approach tends to be, you know, if you want a lawyer who's just going to fight every point because they see everything as kind of binary win-lose, in all honesty, I'm probably not the right lawyer for you. You know, I would never do well for a Donald Trump. If you want someone who, you know, believes in being reasonable, you know, getting a market standard position, focusing on the things that are really kind of important and fighting very hard on those. But if things aren't that important, you know, just getting them agreed as quickly as possible so that we can focus on the big stuff. That tends to be our approach.
Yeah, I'd add a couple of things in there because I've been a lawyer. I know you're all thinking there can't be that old, but yes, I am. You know, I've been a lawyer for over 30 years. And I joined this firm 7 years ago, and in 3 previous firms I was at over the 15 years before that, I didn't hardly use the corporate teams because I'm not corporate. I'm commercial. I do contracts, IP, data protection. And the reason I didn't was because I pride myself on efficiency, being pragmatic, trying to do things for a fixed price. And in those 3 firms, for one reason or another, none of the lawyers was like that. None of the corporate lawyers, they didn't get it, didn't want to do tech, were dodgy or sort of elusive on pricing, etc. So in this firm, I'm not saying we're the only firm, we have a very good model where we set cap prices. We don't go above them unless there's something major change in the material circumstances. A lot of law firms will hook you at a low price, and then halfway through the transaction, they'll come back to you and say, oh, this is more complicated than we thought, it's another 50%, and you can't do anything. And they don't care that you're never going to use them again because you've been sold by then. So it's irrelevant, and they've clocked up some more hours and put some more noughts on the, the balance sheet. So you've got to trust the lawyers and really tie them down to a capped price. I think that's important. Also, you want to be sure that you don't go to a firm probably, and this applies really across for other sort of corporate advisors, you don't want to have too much of a pyramid structure, I think, because what can happen then is you meet somebody, you get on very well with them, the transaction starts and you're put down 3 levels below that. And that means not only is not a person you trust, but it's somebody without the sort of levels of experience like a David or a Robert would have. And there's also inefficiencies that arise from the person 3 levels below getting approval 3 levels up. And that might sort of make the whole deal go much more slowly, less efficiently, could actually hack off the buyers potentially. So those are really key points to bear in mind, I think. And as David said, knowing the market is really important. I've got a friend who's very successful in private equity in the retail sort of space. They buy companies that sell goods. And I've said to him, would you ever look at us for a transaction? He said, no, we wouldn't. Not because we don't think you're good lawyers, because you're not specialists in the retail space. You won't know what market is. You won't know what goes in these kind of deals, what the points are where you concede and the points where you hold firm, etc., etc. And it's true. Whereas, as David said, in the technology space, we know what the market allows for, what the market tolerates, and that's key. So having somebody with that inside knowledge can make things a lot easier, and also can get you a better price because you don't cede on the wrong points. Anyway, enough from me. Back to Robert.
Okay. Very good. I think just with an eye to the timing, I'll go to the next topic, which is preparing for the sales process, and only one after that to get to valuation. So we're on our way. Before you start the process, so we have a short deck that we use, which is based on things that we've seen go wrong in deals and therefore how to fix them in advance. The first is to have what we call an M&A narrative, which is a clear statement of why your firm matters to potential buyers. And in an ideal world, you would customize that for certain buyers or buyer groups. But it's just like when you introduce yourself to a potential client, you'd want to have an explanation of what your firm does. If you're looking to hire an employee, you want to explain it. If somebody asks you at a cocktail party, what do you do? You've got an explanation of what you do. You need something like that for potential buyers. So getting that story right is important. The second thing is you need to be confident that you've got the right team and that everybody knows where they stand, because we've had situations where 3 people have been running a company for a while. We get close to the finish line, and then one of them said to us literally, well, I don't want to keep working with that guy. Make sure that the buyer gets rid of him. Right. And so we then had a week before the end of the deal to suddenly deal with this internal chaos of, our clients having fallen out and one of the guys wanting to kick the other out. So understanding who wants to stay, who wants to go, who's doing what during the process, very, very important. The next topic is to make sure that you've got sufficient funding, right? If you're a smallish company, not very profitable and so on, these processes take some time. The corporate finance advisors, the lawyers, everybody, they will cost some money. You need to kind of make sure that you've got the funding so that you're not negotiating the closing of the deal when you don't have any more gas in the tank, right? Buyers will see that during due diligence, and they will make you suffer if they think you're running out of money, right? The valuation will come down. So being properly funded for the process is important. Then financials, you need to have robust financial systems. You need to produce good management accounts on a monthly basis. Ideally have an integrated financial model which tracks profit and loss, balance sheet items and cash flow in some sort of sensible way with a couple of years of projections. If you don't have that, you can still get a deal done, but you'll probably get a worse outcome than if you could impress a buyer with a 3-year forecast. Most corporates work on a 3-year planning cycle, so you're making it easy for them to slot your numbers into their thinking. then having a good view on where you stand with your customers, right? So we've had people who go into a process and their single biggest customer has a contract renewal halfway through our process, right? The buyer discovers that there's this contract renewal coming up. The amount of pressure that you come under to renew, can we speak to the buyer, all that sort of thing, it really complicates life. You're maybe better off speaking to that particular, if you've got kind of customer consultation issues, speaking to them before you launch your process and say, look, we'll give you a 10% discount on our pricing if you give us a 2-year contract extension or something, trying to fix that, or adjust the timing of your process to avoid that renewal happening in the midst of your process. Another thing we see with people who have service tickets is go and look at your service tickets before you launch your process. If you've got lots of unhappy customers who are demanding that you fix a bug or that you offer a new feature, try to fix it before you launch your process so that you've got happy customers, because the buyer will be looking at your service tickets at some point in due diligence. And if you've got lots of angry comments and 90-day open tickets and stuff, you'll get into all sorts of trouble. And then lastly, if you've got the time to develop relationships with a couple of prospective buyers in advance of a process, that's no bad thing. Getting to meet the business unit heads that are relevant to you at bigger acquirers, at conferences, at events and so on, and creating a bit of a personal connection, it's much better, because if you then start your process and you reach out to the M&A guy, you can say to the M&A guy at the buyer, go and talk to the business unit head. He knows the company really well. He'll support an acquisition. It's much better than if you just go to these guys cold, especially if it's a smallish company that you're selling. There's a whole bunch of other things, data rooms and so on, that we can also talk about. Very important to have a well-organized data room with the key information to be shared with buyers before they give you first round bids, so that when you get bids, those are educated bids. There aren't big surprises. They're not going to suddenly change their mind once they see the real information. So whether in the form of a data room or a very detailed IM or what have you, important facts about the business have to be communicated early. Otherwise, an offer you get is not worth the paper it's printed on, right? If buyers don't know important things about your business, if those things are good, they're unlikely to revise their offer upwards and give you more value. But if those things are bad, they are very likely to reduce their price, and that just leaves a sour taste all around. Anything else from the SMB team?
No.
That was pretty comprehensive, I think.
Okay, very good. So then the next topic was valuation, price setting, negotiation. Huge topic. We can spend ages on this. The first thing to understand is that, generally speaking, in technology businesses, people are looking at an enterprise value, which is a number that they determine based on different methodologies. And then to get to the equity value, the value that shareholders actually get paid, you will remove from that enterprise value that they've determined debt-like items, and usually some adjustment for net working capital. Why does that matter? Well, a lot of people don't make the distinction between enterprise value and equity value in their minds. And if their business has debt, they kind of forget about that. But a buyer will be very sensitive to that. And they say, well, we're not going to pay you the full value of the business if we then have to settle some debts. And debts aren't just financial, like bank debt, right? It applies to things like tax liabilities. It applies to things like technology debt, perhaps, right? If some of your product is really old and it needs £1 million to get up to date and be competitive again, a buyer will find that in due diligence, say, well, look, we're going to have to invest £1 million to fix this, so we're not going to pay you full value for that product, right? And one of the trickiest things is if you're selling your products and getting cash up front, then on your balance sheet, you will have a deferred revenue balance, right? So you've got the cash early, but you then have an obligation to provide a service for a year or 2 years or what have you. And generally speaking, if you don't think about this early, buyers will treat that as a financial liability, and they'll say, oh, you've got £1 million of deferred revenue on your balance sheet. That's an obligation to provide a service in future. You've taken the cash already, so we're going to subtract that from what we're paying you. We have a good track record of getting buyers to agree at the heads of terms stage to treat deferred revenue as a working capital item, which is much less bad than a deferred revenue item, than a debt-like item, and therefore preserving that value for the sellers. Not always, but if we can hammer that agreement out before they get their accountants on board, we can win that quite often. And that often is bigger than our fee, our success fee, right? So it's real value to shareholders. So firstly, enterprise value versus equity value is quite different, and thinking through it early can help you preserve a lot of value. Now, the second question is, well, where does enterprise value come from? How does somebody determine value? Right. So for subscription-based businesses, the main metric that people look at is based on the ARR, the annual recurring revenues, right, of that business. And that's typically your monthly recurring revenues multiplied by 12 at the time you fix price, right, which is heads of term stage typically, right? And someone will say, software buyer will say, well, we'll pay you 6 times ARR for that business. How do they get to 6 times? Well, it's a combination of things. It's partly about growth in your business. It's partly about how much cash you're burning. So ARR was more important in 2021 when everybody was paying crazy valuations and didn't care about losses. So that was the only thing that people looked at. These days, people care about losses. And if a company is burning cash and losing lots of money, you might not be able to sell it at all, right? But ARR still tends to be the main metric that people look at for software or subscription-based businesses. And they will pay a higher ARR multiple for a business that's growing very quickly and quite cash efficiently, right? And you can get to 10 times ARR if you've got a really great business. As businesses mature and they start chucking off tons of cash, software companies can be very profitable, then you suddenly start looking at EBITDA, earnings before interest, tax, depreciation, and amortization. I'm going to assume that for this crowd, we're still more in the sort of venture and early stage, and therefore we're more looking at ARR type multiples rather than EBITDA. If you've got a business, though, that is selling products or that is selling human-based services, right, or reseller businesses and so on, then ARR isn't such a meaningful multiple. You could still get a revenue-based multiple, and somebody says we'll pay you 1 times revenue or 2 times revenue. But generally speaking, I'd say that world is more a world of EBITDA type valuations. And over a long time, for services business, my rule was 1 times revenue is the same as 10 times EBITDA. That means you've got a 10% EBITDA margin, right? And if you've got a very good business with higher margins, your enterprise value, your revenue multiple will be higher. And if you've got something unique about your business, you can also get a higher multiple. And if you're growing fast, you get a higher multiple. But typically for services businesses, I would say 0.5 times for a reseller type business to 2 times for a very high performing services company. That's the normal range in terms of revenues. And the debate tends to be, is it last year's revenues or this year's revenues? And can I find other arguments to push that multiple up, right? But it's a narrower banding than if you've got a software type business. Finally, there are IP heavy businesses, right? So I don't know, semiconductor design businesses and people with magical AI algorithms and things like that. Valuation multiples no longer apply there. It's, whatever the buyer is willing to buy. And my best example is Google bought a pre-revenue business called Android for $50 million. On the one hand, that seems like it's an infinite revenue multiple, right? seems crazy. On the other hand, look at Android today. It was a very worthwhile acquisition, right? So all of these things break down at super high growth rates, super low growth rates, businesses in financial distress, or businesses with super valuable IP. And then it's a crapshoot, it's a negotiation, it's, you know, you have to kind of figure it out, and ideally have smart advisors who can find every possible argument why the number should be higher rather than lower is helpful. There are also different methodologies you can use for determining valuation. So there are similar listed companies you can work out based on their market cap and their net debt profile and enterprise value. And then there's a read across to your business perhaps, but it's a bit difficult to say that that's that, you know, it's always the same multiple. Listed companies are usually bigger, they have better corporate governance, but funny enough, they're also actually lower rated than empirically we see some private company transactions taking place. So not a perfect solution. With acquisitions of similar companies, it's often a very good proxy to what you're worth if you can find the data. And somebody said, well, you know, can you find the data? Sometimes you can, but it's a lot of detective work, and in many transactions, especially small ones, you won't find data. But professional advisors will have databases and things that maximize the chance of finding that data. Finally, there are DCF, discounted cash flow valuations. You read about those in business school and people do them all the time. In tech businesses, they are sadly completely useless, because once you layer different levels of assumptions for a high growth small business, you can prove any valuation you want under the sun, and the buyer can do the same, you know, putting higher discount rates on it and so on. So it's kind of an interesting intellectual exercise. You make junior bankers do it, but it actually applies for mature cement companies, not for startups. I'm going to pause here partly for our lawyers to say a few words and partly to blow my nose. Excuse me.
I will just interject because we just had I think Nitin's back with us. Do you want to actually, I saw your message, Nitin. Do you want to actually say what you were writing so that, you know, we can get response?
Sure. I think absolutely useful info, by the way. Thanks, Rob. So what I was actually asking is, I mean, as a founder, one is obviously you guys mentioned it's always start early, as in plan early, but equally, when is it too early to sell a SaaS business, which is pretty promising? And again, as you mentioned, founders will always have a certain vision, which kind of, obviously, until you realize that, then there's the difference in what you might think the value is versus what a potential buyer thinks. And the other part of my question was around, I mean, I think I was speaking to one of the companies who are doing pretty well. This isn't us, but so the guy was saying, I can easily find people willing to give me 10 million at a pretty high valuation for 10% of the business, whereas they won't give me double that for almost 100% of the business, kind of thing. So if you want to exit. So I guess that's what I want to understand from our perspective. We are seeing a lot of interest from investors who want to invest in the business so that we can grow. However, equally, when we start speaking to people who have shown interest, but from exit perspective, then those valuations just completely don't match at all. So I'm not sure if others can relate to this, but it would be quite useful to understand some of those things.
Absolutely. So we don't say prepare too early, but approximately 2 years before you're planning to sell is a good time, right? So you could do it faster or slower or so on. I wouldn't start preparing 5 years before, because things change way too much. I think the more important thing is understanding yourself. And I have some nice slides, which unusually for corporate finance pitches quote Aristotle, which is about understanding yourself, right? The wise man understands themselves. And the important thing is that you, as the owner, or you, if you're, you know, collectively as the founders of a business, do actually need to take that reflection and think about what it is that you are trying to achieve. I would say that if you enjoy what you're doing and it finances your, financial goals, I would keep growing for as long as you think you can maintain growth, right? Don't dilute yourself, don't sell the business, don't become an employee of somebody else and do all this stuff. It is fun to work with Simon and David and me, and you'll enjoy it. But if you can put that off and keep growing value in your own business in a way that's satisfying to you, it's better than putting your stuff in a bank account and, your cash in a bank account and getting 4%. So don't sell early. On the other hand, don't allow your business to go off a cliff because AI is coming, it's going to destroy your business, and you blindly carry on running your business. If you see a big risk, if major competitors are moving into your market and things like that, you might just say to yourself, look, let's be realistic. The market is changing. I need to exit while it's still worth something. And the worst thing is that people who kind of get into that slope where the value of their business starts to decline for competitive reasons or otherwise, but who are blind to exit and find that something that was worth 50 million 2 years ago is worth nothing, right? So, and in technology, these changes can happen relatively quickly. So I think recognizing when it's too early, well, the starting point is to recognize what are you trying to achieve? Are you enjoying the journey, or do you have financial goals that you need to meet by selling the company or whatever? And we can't really advise very much on that, but we can act as a bit of a sounding board, and we can also come up with, well, we think your business is worth this much. So if that's what you want, yes, sell it now. Or if we don't, if we think it's not worth that much, grow it for another 2 years. Okay, but so the timing ultimately has to be what you're thinking about, although bear in mind sometimes you get approached and that might accelerate your thinking.
I would just chip in there, Robert.
Yeah.
The best example I've heard of this one is apparently, must be about 20 to 25 years ago now, Blockbuster, as we all remember, the place we used to get all those videos, had an opportunity to buy a nascent business called Netflix for next to nothing and didn't see the potential. Now the rest is history, as they say.
Yeah, and there's many of those examples, and then counter examples where Time Warner sold to AOL, and that was a big mistake. But anyway, for shares, in fairness. Now, another thing that you touch on, you didn't quite ask the question, Nitin, but it's about structure. Everybody thinks about valuation, right? Oh, but what valuation can I achieve? But valuation is part of a deal, and whether that's an M&A deal or an investment deal. So VCs, love them as I do, are weasels, right? They will put liquidation preferences and accelerated vesting rights and all manner of baroque things into their investment, which means that if you tot up the number of shares they own, it looks like a modest shareholding, the 10% you mentioned earlier. But if you look at their return on exit, well, they get their money back and then they get shares and suddenly it's 20% or what have you. So, and the same is true of an M&A deal. People will say, oh, well, what value are you offering me? Could, on the face of it, seem very high, but if it comes with all sorts of bells and whistles, right, leaving you highly exposed to claims would be one risk, or very high top line valuation, but in fact it's an earnout over 3 years with impossible conditions, or you're taking share. A very typical thing is an American buyer will come along and say, we'd love to buy your company, we'll give you 30% in cash and 70% in shares in our business. And people are so excited to take shares from an American company that they lose all common sense, and then they discover it's leveraged and there's all sorts of horrible shareholding rights and so on and so forth. And in fact, the shares, you control and understand your shares. You have no influence or understanding of the shares you're taking for the business that you've created. How is that wise, right? So valuation is one piece, but structure is very important also. And then finally, there is risk, right? A transaction will cost you tens or hundreds of thousands of pounds in fees, one way or another. It will be 6 months of grueling, quite fun in parts and very interesting existence, but grueling, right? Do you want to go through 5 months of that and then find that the guys that you've been working with are bastards and drop the price by 20%? And if they do that, will you have the moral umbrage to pull out again, or will you be so exhausted that you just cave and accept it? So there's risks around things. Some of the risks are within your control. If you don't prepare well, if you don't deal with tax stuff and so on, then those risks are going to fall on you and they will come out in due diligence. But there are other risks which come from the buyer, and taking a lower price from a credible buyer with cash could be much, much better than taking a high price from somebody who's offering you, toilet paper and, and is shifty. And there's no way of always telling up front what somebody is like, but you can take soundings. And for some of the big private equity backed businesses or the Constellation Software of this world and so on, people like us will have lots of experience that they can say, well, watch out for this, or, they typically do that. So,
okay. So
yeah.
go on, Rob. I was just going to say, we're coming towards the end of the session now. We've lost Aaron. Before we lose anyone else, because Nick seems to be on the move. Do you want to, are you all right for another 5 minutes, Nick?
Well, they're just closing where I am, so we're going to get kicked out. That's fine for 2 minutes.
Okay.
But I did want to ask a question. It's kind of relatively specific, but where we're at with our company, so we were planning to build like a platform with multiple different authors and topics on. But interestingly, one, for example, grief has taken off, and then we could do a similar thing with the other individual ones. But what's interesting is like a funeral director's company like Dignity might be interested in this one, which is around grief. Another one might be interested in another one. And so we're starting to think about how should we be structuring? Should we be having like a holding company at the top, which holds the technology, and then smaller ones underneath, which holds the actual IP for the different topics, and how will that impact the sales and selling a company? And this is the kind of stuff I feel I need to get my head around at some point.
So quick answers, because we don't have much time. Firstly, to get an exit, simplicity trumps lots of things, right? If you've got a really complex corporate structure with IP shared across different things and so on, it probably is going to make your company unsellable. Secondly, scale is usually an advantage in these things, right? There are more people who will be interested in buying something with a bit of scale than they are in buying lots of fiddly things, even if those things on the face of it seem more relevant to them. There are more buyers who want to do, a meaningful acquisition than there are credible buyers who would just want to pick off tiny things. So as you get bigger, when you're a 30 million pound turnover business, at that point, you might say, well, we've got a high growth division with these characteristics. Let's do something with that. And we've got a low growth business. We could put debt on it and sell it to somebody else or what have you. But for small businesses, introducing tons of complexity generally doesn't maximize your exit options, I would say.
Okay. I think probably, although we had one more point on the agenda, we'll probably not take that one, the auction one. You did talk about it slightly at the beginning anyway, Robert. Do you have any final comments, David?
Nothing else from me.
Okay, listen, well, I hope you both found it useful. Aaron's now left us, so I can't say all of you. And thank you very much, Robert. As I said at the beginning, it was very erudite, it was very interesting, and you're definitely not the average corporate finance advisor. And we like to think we're not the average set of lawyers either. Anyway, good to see you, and I hope you found it useful.
Thank you, guys. Very
It was
useful.
fantastic. Really helpful. Thank you so much,
Thank you,
Robert.
everyone.
Thanks,
very nice to meet all of you.
David.
Thank you.
You too.
Bye.
Take care. Thanks, guys.
Yeah,
Bye-bye.
bye then.
Bye.